Ladies and gentlemen, good day and welcome to the Gulf Oil Lubricants India Limited Q3 FY23 conference call hosted by Yes Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nitin Tiwari. Thank you and over to you.
Thank you, Mike. Good day, ladies and gentlemen. On behalf of Yes Securities, I welcome everyone to Gulf Oil Lubricants India Limited's third quarter FY23 earnings call. We have the pleasure of having with us today the MD of Gulf Oil Lubricants, Mr. Ravi Chawla, and the CFO, Mr. Manish Gangwal. I will now hand over the call to Mr. Chawla for his opening remarks, which shall be followed by a question and answer session. Over to you, sir.
This is the operator. Can the management hear us?
Sorry, we are on mute. Yeah. Thanks, Nitin. Good day, good evening to all of you. Let me start by wishing all of you a very happy new year, since the first time we're meeting in the new year, and hope all of you are well. This is the quarter 3 call for the investors. I'd like to start off by sharing our delight that we've had an all-round good Q3 and many milestones achieved. But let me start with revenue, which has grown year on year by 30%. We've also seen crossing 90 crores for the first time with a 17% growth. And backing all this up, we've seen a double-digit 10% growth in volumes, which definitely for us has been a good achievement from the team. And where we saw, an environment where we had some subdued demand from the rural, especially motorcycle segment, there were continued cost pressures in some of the key inputs, and the INR was depreciating. But we've seen excellent all-round efforts, and which really shows that we have a strong brand and business model. We continue to deliver 3 to 4x the market growth, and definitely we are gaining market share. And distribution again is growing well. Double-digit growth in distribution, a lot of efforts on the ground, both with ATL, BTL. We're investing in our brand, and really this sets us up well for the future growth trajectory. While we saw costs being going up in some ways, it has steadied, but margin management will continue to remain a key focus area. And we'll use a balancing approach of volume versus margins, as we have seen some stability in the base oil cost. And definitely we are looking at reviving growth in agriculture, two-wheeler and rural demand, which, as you saw in the budget, a lot of good things coming in. So I think given all this, and of course last quarter we saw the commercial vehicle oils doing very well, and we also saw the B2B segments oils the demand for oils going up. And definitely this is really good for us. The overall B2C B2B ratio in Q2 was 58-42. There was some slowness we mentioned in MCO Agri, but really we have seen all other segments doing very well, excellent growth. We've also seen that of the initiatives we had taken in terms of our distribution are coming off. Distribution we are estimating now has gone up to 80,000 as compared to 70,000 earlier. And we are definitely looking at opportunities to grow our market share further in the passenger car motor oil segment, where we have seen again good demand coming in. Overall, I would say that a lot of the programs we have put in are giving us results. Demand should be good in the coming quarter, and we should be able to manage our margins. To add a bit on the EV fluids, we are happy to share that we tied up with 3 OEMs, and we are looking at other 2 OEMs where we can supply EV fluids. We'll also definitely have looked at certain things in the EV value chain, like our Indra chargers, which we are now piloting to see how we can localize it, and working with our partner Electrify to get more customers. Some more decisions on the EV are being discussed at board level, so that should be some more moves into that. I'd ask Manish to now come in with a few more details, and then we'll later on happy to take questions from all of you. Thank you.
Thanks, Ravi. So, I think as Ravi mentioned, it was a very good quarter in terms of overall profitability, with EBITDA crossing 90 crore. And we have seen a slight sequential improvement in the EBITDA margins as well. At the same time, during the quarter, we have seen that gross margins also have stabilized at around 37% QOQ, in spite of an higher AdBlue offtake during the quarter also. So that's also giving us a signal that the input cost side pressures are stabilizing. Also, we would like to highlight that during the quarter, we have had a good improvement on the working capital side, and our overall working capital has improved by nearly 10 days in the gross working capital cycle. So from last quarter, September quarter, 114 days to we are nearly at now 100 days. So which is a very good improvement, I would say. And with that, our cash flow from operations for the 9-month period is at 180 crore. So which is a fantastic sign, I would say. Overall, finance cost continues to remain high because of the volatile INR versus dollar, because we import a lot of raw material which are in dollar denominated. So during the quarter also, out of 10 crore of finance cost, nearly 4.5 crore is the forex impact of mark to market. But other than that, I would say overall we have seen an improvement in the profitability at PAT, PBT level also. Overall, for the 9-month period also, we have our revenues grown at 42%, EBITDA growth at 30%, and PAT growth at 15%. So overall, these are good numbers. I would say also during the quarter and recently, last 10 days ago, we have been awarded with the plaque award for the best excellence in financial reporting from the Institute of Chartered Accountants for our annual report 21-22 in the category of 500 to 3,000 crore companies, which is a very, very heartening thing for the entire team here. And of course, it gives a confidence on our financial reporting statements and the disclosures. So that is also, I would say, we want to highlight. Yeah, over to Ravi again. He wants to add a few more points.
Yeah. So as we have seen, the motorcycle segment, which I mentioned, is seeing some, sometimes different demand coming in rural. We have introduced, we have seen consumers shifting to brands which are definitely at the lower end. To address this, we revamped our economy segment, brand called Gulf Zip, and we've had 2 offerings which have been launched at different price points. So this will help us to cater to the rural markets and some of the lower end market. So 2 brands like Gulf Zip Smart and Gulf Zip Plus. So hopefully this will help us to definitely get the growth back. Rural demand, which has also been subdued, the company believes in long grain oils, as we've been talking about. Our flagship brand Gulf XFG Supreme Plus has been now improved further, and we've launched it with a longer drain interval with a campaign with MS Dhoni. Basically, the industry-leading benchmark has been set by this XST Supreme Plus at 1,000 hours, which is the drain interval claim on this product, and that is the highest in the industry today. So happy to share these 2 launches which have happened and will help us to further grow and gain market share in these 2 segments. Yeah, Manish. So we can go now to the Q&A.
Yes. Over to Nitin for Q&A, please.
Sure. Thank you, sir. We will now begin the question and answer session. Participants who wish to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have the first question on the line of Gunit Singh from CCIPL. Please go ahead.
Hi, thank you for this opportunity. I have a couple of questions. So firstly, I'm a bit new to the company, so I would like to understand what would be the impact of EVs on the company in the long term into the lubricants space. So what would be the impact of EV Secondly, I would like to know if we would be having any buybacks in the future, in the coming quarters or maybe next financial year. And thirdly, in view of this EV impact, what are the diversification plans of the company? Are we planning to take over some other firms, or are we planning to diversify into new EV-specific products or anything like that? So these are my three questions.
Yeah, so I think Manish and me will try to answer this question, Mr. Guneet Singh. Basically, as we've been briefing all of you, the lubricants, as we look at it, and also the experts, which is Klein and others have seen, India is the third largest market of lubricants, and as we see, the penetration of vehicles is still going up, whether you take two-wheelers, commercial vehicles, tractors, and of course, industrial segment is also going up. So with the growth that we have and the anticipated EV penetration, which will happen mainly in two, three-wheelers, in buses, cars, and the data that we have and we estimate, based on all this, for the next 10 to 15 years, we see the lubricant demand continuing to grow at 2 to 3%. And that also the experts have given that opinion. So there is going to be an increase in commercial, in vehicles, IC engines, in all segments. Of course, we are seeing that the two-wheeler segment, three-wheeler segment, the bus segment, the car segment, you will see EV going to different levels. Every 5 years, if you take, that is there. And that will have some impact. But overall, the growth of core lubricants is going to continue for more than a decade. So this is our reading, and we are estimated, even the experts have backed that up. We are diversifying, as I mentioned during my opening remarks. We have looked at investments in the EV value chain, where we can leverage our brand, our distribution, and we have various relations with B2B customers, OEMs. We have announced and invested in a global company who's into car chargers, Indra, and those chargers have been tested in India in terms of their performance, and we're looking to bring those in. And second investment we have made is in a software as a service company, the brand name Electrify, and we are working closely with them to expand their customer base. We have also got a few other areas we are identifying, and we'll come up with those plans shortly. It is discussion, and we are working on those. So on these two areas, I would like to share this, and Manish, maybe you can comment on the buyback and add to whatever idea.
Yeah, so you see, we have been following distribution policy. We have an announced dividend policy as well. Company has, if you see the track record of last 7-8 years, company has been distributing 35% upwards of the profits back to shareholders, either by way of dividend, or last year we announced a buyback as well. And in fact, with the buyback, the payout was upwards of 60%. So company is looking into, as Ravi mentioned, a lot of investment opportunities in the allied activities in terms of electric vehicles, EV value chain. We are also going to continue to deploy resources or capex in our current business of lubricants, as it is growing double digit continuously, and we foresee the same to continue in terms of growth. So overall, the board has a utilization of cash policy, and they deliberate and decide on the way forward. So specifically, we will not be able to comment on buyback, but we have a very strong cash distribution in the past, which we can clearly say, which is roughly in the range of 40%.
All right. Thank you very much.
Thank you.
Thank you. We have the next question on the line of Swacha Jain from ANFL. Please go ahead.
Hi, sir. Thank you for giving this opportunity. I might have few basic questions because I'm attending this call for the first time, as I've recently started tracking your company. So my first question is, if you could, give us the revenue and the volume breakup segment-wise per Q. And my second is, if you could help us understand the margin.
This is the operator here. Your voice is breaking up in between. If you could go off the speakerphone.
Yeah. Am I audible now? I'm so sorry.
Yes, you are.
Yeah. So I needed the revenue breakup and the volume breakup segment-wise for Q3 and 9 months. Then if you could, help us understand the margins that we have in B2B and B2C. And if you could give us the cash and the receivables number for December. And my last question is, sir, you mentioned about investments in two companies, right? Indira and Electriv, if I've got that correct. If you could help us understand, how much investments have we made, and what does Electriv do, and how these two investments are going to help us overall, in our EV strategy. So what are we thinking on the EV side on a long-term basis? And just if you could, explain the industry, like, how much are the fluids required for the, EV, and how does the overall industry, you think, on the EV fluid is going to shape up, with the EV penetration increasing? Thank you, sir.
Yeah, so maybe I will start with the revenue breakup and all. So if you have seen our press release, we have achieved close to 2,200 crore of top line for the 9-month period. And for quarter 3, it was 781 crore. Typically, our ratio of B2C, B2B sales is 60-40. So 60% is B2C and 40% is B2B. In this quarter, it was 58% B2C and 42% B2B versus last quarter 57-43. So there is a slight improvement in the B2C versus last quarter. But overall, because of the slowdown in retail, in rural and certain segments like agri and motorcycle, we have a scope to further improve our B2C ratios back to 60% in the coming quarters. On the overall product classification side, roughly 40% of our sale is diesel engine oils. Personal mobility, which is including motorcycle and car oils, are in the range of 20 to 22%. Then we have industrial products around 15%, and other automotive products are around 25%, which are gear oil, greases, AdBlue, etc. So all this is the product breakup, I would say. Overall, our gross working capital is around 100 days this quarter at the end of December. And as I mentioned in opening remarks, we are a net debt-free company, and close to 200 crore of net cash is there on the balance sheet. So I think we have covered your financial side. On the EV slide, maybe Ravi can take and explain.
So just volume breakup, would you be able to give?
So for the quarter, we had 34,000 KL volume of core lubricants, and AdBlue, which is a category which is doing well for us now, that was 21,000 KL for the quarter. So total volume was 55,000 KL.
Okay, thank you.
Yeah, on the investments we have made, Indra is an investment by our parent company, Gulf Oil International, and us. So we have invested in that, and we have got, in terms of our investment there is about 30 crores in Indra so far. Of course, our parent company is also investing, and they are into chargers for destination charging for cars, and we are looking at that product being brought to India. And in the case of Electrifi, this is a company which has software as a service. They provide the software which connects the vehicles to the to the whole charging system, to the battery systems, and they provide this platform for many companies. In fact, 40%, 50% of a lot of the segments are on this software service. They are expanding now, and we have invested 26% as our stake in their company, and we are helping them grow the customer base. The way we see this is that Gulf, with its brand, its distribution, and of course, as a mitigation strategy, the EV value chain presents a number of opportunities. So we are started with this, but this is definitely one of the things to take ahead for us. So we'll be coming up with specific areas where we'll be investing, and we'll also look at how we can leverage our brand, our touch points, our distribution, our B2B relations, both in India and in a few global markets. So we have done a study, and we are going to come up with that shortly. On EV fluids, currently we are supplying to Switch Mobility, which is into electric buses, Piaggio, which is into three-wheeler EVs, and also Altigreen, which is into three-wheelers. We are also given our products for many of the OEMs who are both traditional OEMs and expanding to EV, and new OEMs bring in EV. Basically, electric vehicles will not have an engine, so they'll not have engine oil, so the consumption is much lower than what an IC engine has, but they would require fluids for transmission, brake, for cooling, and those kind of fluids would be required, grease, etc. So the market is not going to be very large in terms of volume, but it is an important element, and we are being part of the environment here with a good share of lubricants in all these segments. So it would be a natural extension to give EV fluids, and it is to be a segment where the product would evolve in terms of the thermo and electric properties that are required in an EV. And that's really where we have a global portfolio, and we are working on expanding that as the business develops. It's not going to be very large in terms of volume, in terms of the overall. So as I mentioned in my remarks, the core lubricant segment continues to be a segment growing in India, which is the third largest market, and that continues to give us both revenue, and we continue to increase market share in that.
Right. Okay. Thank you, sir. I'll be join again if I have any follow-up.
Thank you. Thank you, Mr.
Thank you. We have the next question on the line of Aditi Chaturvedi from EY. Please go ahead. Ms. Aditi, can you hear us?
Yes. So thank you for giving this opportunity. I had a question with respect to the volume. If you can give a breakup with respect to the B2B and B2C. And so yeah, AdBlue you have already given. So if you can, please.
So, Ms. Aditi, I think we have mentioned already that overall lubricant volume is 34,000 KL for the quarter, and 21,000 KL is AdBlue. And within that, roughly 40% is diesel engine oils, and the personal mobility is around 20 to 22%. Industrial oils are around 15%, and others are around 25%. So that's our usual breakup.
And can we know the percentage of ASP in terms of the turnover and any battery turnovers as of now?
So this quarter our battery turnover is around 20 crore, and YTD at around 61 crore in terms of our batteries. Rest all is lubricants and AdBlue put together.
Okay, thanks, sir.
Thank you.
Thank you. We have the next question on the line of Harsh Maru from MK Global. Please go ahead.
Sir. Hello, can you hear me?
Yes.
Yeah.
Yeah. So, sir, my question is on AdBlue. So, what do we see the addressable market size for AdBlue, and what is our outlook for FY24? So, that would be my first question. And the other is, have we seen translation of cool-off in base oil as well as additive prices, like improving margins for the current quarter? Is that like trend of cost pressures cooling off reflecting in the margins? If you can throw some light on that.
So we'll take the second question first. Basically, we have seen some sort of a stability in the base oil pricing, which is a key raw material for us, in line with crude. But this has been partly offset by the depreciating rupee. As you see, every quarter the rupee has been on a depreciating mode. If the rupee continues to remain in this range which is there today, and crude also is in the range of around $85, we see stability in the input cost, although the additive costs, which are another key critical components of the entire process, continue to remain very high, and other inputs are quite stabilized now. I would say the packaging costs, the freights, all those have stabilized. So as long as there is no dramatic movement in crude or rupee, we should see stability in the input cost going forward, which we have seen already partly coming in quarter 3 as well. So now on the AdBlue market, Ravi, over to you.
Yeah. So AdBlue basically is being used in all BS6 vehicles, mainly heavy-duty trucks, passenger cars, medium-duty trucks, buses, light-duty vehicles, and of course now with some non-road mobile machinery also. So AdBlue, normally these BS6 and some BS4 also started using AdBlue. So technology which basically the emissions that come out, it is this liquid that is mixed urea, automotive urea and specialized water, which is sprayed into it, and the emissions, they reduce the NOx, and therefore it controls the emission levels, and you get something which the environment is friendly with. Roughly 3 to 4% of the diesel consumption is used here, and our estimate is that this is about 500 million liters. In 2023, it will be around 500, and there's an increase happening, probably 30-40% increase every year, which will happen, and that's the volume this market will have. And Gulf is well placed because we are very strong in the commercial vehicle segment, as you know. We also are present in all the other segments, the light duty vehicles, and we have also been a pioneer in making AdBlue. We started our plant many years ago, and now we are well poised with our brand distribution and OEM tie-ups to leverage this, and we are growing along with it. It is definitely a price sensitive segment, so the margins are single digit, but we continue to grow in this. So we would expect a 30-35% increase of the market size every year, but we'll have to basically see how we can further grow in this, and we are well poised to use this opportunity because it is synergistic with our commercial vehicle and other segments.
Thank you so much for the detailed answer, and all the very best.
Thank you.
Thank you. We have the next question from the line of Keshav Garg from Cyclical PMS. Please go ahead.
Sir, I wanted to understand that as the drain interval of new engines keep on increasing, so the first fill keeps on getting more and more important, and maybe eventually a stage will come where it will be only first fill, and it might last almost for the whole life of the vehicle. So in that case, the industry is basically shifting from B2C to B2B. And since B2B margins will be a fraction of the margins in B2C, so then how do we deal with this adverse situation?
Yeah, so Mr. Garg, it is not like that, because a lot of the vehicles, whether you take trucks, cars, two-wheelers, tractors, the factory fill what you have is generally based on a period and kilometers, after which it has to be changed. So what you're talking about is highly synthetic lubricants which go into some special applications which are lifetime, and certain cases you do have products which are very expensive products. So I would say 98% of the market is still going to be lubricants which will require change based on the kilometers used and the period of use. So you will continue seeing that the lubricant requirement will continue as a cycle. Just to give you an example, if you have a truck and you are using a lubricant for 50,000 kilometers, so you will change your lubricant, because the lubricant will then be required for working the engine, cooling the engine, making sure the lubrication is fine. So there is going to be a cycle. Normally what you see is the vehicle growth in India is 6% as average overall, and lubricant demand is growing 2-3% because the lubricants are getting better in terms of their long drain and their usage. So that's generally how the industry is going 2-3% every year. But you will see this continuously, continuing in terms of consumption.
So let's say that 5 years back, approximately what was the bifurcation between B2B and B2C? Now you said that 40% is B2B. What was this 5 years back approximately?
For us, we said our split, Gulf split.
That is Gulf split is what we spoke about.
Right, sir. So today we are selling 40% to B2B customers. So 5 years back, approximately, this must be lower, must be like 30% or even lower, right?
Yeah. So because our focus has also been on improving our industrial portfolio, and there we have seen high double-digit growth over the last 5 years, and we continue to remain quite focused on growing our industrial portfolio as well, because we still have a comparatively lower market share in our industrial, less than our overall market share. So we want to grow our both portfolios, automotive and industrial, So the mix is also because of our mix is also shifting partly because our B2B is also growing. And when I say B2B, it is more a route to market. So the product split for us continues to be around 85% being automotive products and 15% only our core industrial products. So even B2B customers buy a lot of automotive products, those with large fleets where we directly supply. So B2B for us is where we are directly supplying, including the OEM first fill. Factory fill is also a B2B for us. We classify it that way.
Right, sir. And sir, also wanted to understand that all the EV fluids that you are selling to your customers, so on a per vehicle basis, how much is the contribution? I mean, let's say if it is 100 rupees for a EV vehicle, for a IC vehicle, and for a EV vehicle, that is how much? Is it 50 rupees, 40 rupees, 20 rupees, like ballpark?
Well, it depends on the segment. But basically, the engine oil is not going to be used. So engine oil is definitely more than 50-55% of what the consumption of the vehicle is. So that will go away because EVs will not require engine oil.
So, sir, I understand that. Sir, I'm saying, let's say for a 10 lakh rupee passenger vehicle, if it's a IC vehicle and we are selling 100 rupee worth of lubricant for that, instead of that, to a 10 lakh rupee EV of the same segment, how much will be the value of the fluids that we are selling? I mean, I understand that there is no engine oil that we'll sell to EV, but whatever...
Yeah, so as I told you, engine oil will be roughly 55% plus. So that will go away.
Okay, so basically, let's say, so only...
It could be even higher. It could be higher for a motorcycle. So obviously, when it's an EV vehicle, it will only take transmission oil, brake fluid, grease, some coolants. So these are not... Engine oil is the major component in a vehicle.
Okay. And also we have to see that the vehicle population of EV right now is too small to see how much of vehicles need a replenishment of the EV fluids at what drain intervals. So this is a very evolving area, and we'll need to be continuously monitoring the data for next 2-3 years to understand this very clearly.
Yeah, and as mentioned earlier in a few times, the growth in lubricants is going to continue 2 to 3%, which it is today, because the number of IC engines will continue growing and using this. So we don't see that the demand for lubricants will come down even with the EV penetration that is going to happen for the next 10-15 years.
Right, sir, understood. And so lastly, just wanted to touch upon one issue, and so especially in the light of what you were saying, that we are not in a dying business and this business will continue to grow for more than a decade. So it becomes more pertinent to appreciate that our stock price is back to 2014 levels, whereas the business has grown many folds, and our price to earning ratio has also fallen from a peak of almost 40 times in 2017 to less than 10 times today. So a share buyback makes more sense when the share is undervalued, so that we can buy back and capitalize on the lower share price to extinguish higher number of shares and increase our earning per share permanently. Sir, so instead of the generous dividend that you are distributing, if that funds can be diverted towards the share buyback, so shareholders will gain a lot, and also it will be far more tax efficient. So kindly consider that suggestion.
So the board will obviously look into all aspects as you are suggesting while deciding the payouts.
Right, sir. Thank you very much and best of luck.
Thank you.
Thank you. Thank you. We have the next question on the line of Hemal, an individual investor. Please go ahead.
For the opportunity, and congratulations on the award and on the working cycle reduction also. I've actually, you mentioned gross working cycle. If you can provide some basic on net working, what is the net working? Is also close to 90, 80 days or 100 days? What is the?
So net working capital usually is around 55 to 60 days.
Okay. Thank you. Now, I have another question basically on this cost. I think cost of raw materials. You did mention if everything remains at this, $81, $82, $85 oil, and the cost pressures are out, what is, and for a moment, if you remove AdBlue, right, for whatever reasons, that's a single margin, are you expecting the margins to be back to the normalized 15%? The last time you said mentioned 12 to 14% is what we should look at overall. But if you remove these AdBlue volumes that are increasing, are we back to the normalized? You expect this quarter four to be back to the normalized 14-15% margin for our core lubricant business that we used to have?
So I think, Hemal, and for your benefit and for the benefit of everyone, you see, the prices have gone up multifold. I mean, nearly 30-40% increase in the prices over the last 1 year period in terms of passing on the input cost. So that increases the top line, while not necessarily the per liter margins remain similar. You pass on the per liter cost increases to the end consumer to recover. Our per liter margins are back to the range of around 24-25 rupees, which has been the band. In some of the quarters, we have made even 27 rupees, but mostly in the range of 24-25, we are back to that level. So we have been able to protect our per liter margins, but as a percentage, these are looking weaker because of the top line growth which has happened. And as we mentioned in the earlier questions, that input cost is stabilizing, while we remain cognizant of the competitive pressures as well, because in a competitive environment, we have to be pragmatic in terms of our margin management. So we'll continue to follow both in terms of chasing volume and having a decent margin management.
So do you expect any price decrease? Have we ever, is that even in the ballpark that it's weak for competitive pressure or for anything, given our volume and balance strategy? Is there any price declines that have already started this quarter, or any price increases? Or if you can shed some light on that, it would be very helpful.
No, we are not seeing any price increase now, but definitely you see there is the trade and the bazaar market and other places, there are schemes which people would give competition. So we have to react to certain schemes segment-wise, which we continue doing on a normal basis also. Plus, in terms of our B2B and OEM business, there are price variation clauses. So there are built-in clauses. If the base oil is coming down, there will be a pass-on. So you have to manage this, and as Manish said, it's a balance between volume. We are hoping that we can improve our margin also through mix. But I think, as we have been saying, we would like to be ideally in a 14 to 16. But, as Manish explained to you, that though our rupee has come in, our top line has gone up by 30%. So then the percentage comes down. So we would like to do both, improve our margin, improve our percentage. But I think it's a journey. We are hoping we can, like this quarter, we improved our EBITDA margin by point, from 11.1 to 11.5. Yeah, 40 basis points we have taken it up. So I think this is part of the balancing, and we are also gaining market share. So we are happy to gain market share and keep a balanced approach in terms of margin versus volume gain.
So
we are hoping we can do better, but we do want to also be competitive.
No, I understand. The reason where I was coming from is, if our working cycle is improving and our margins will go in the right direction, I think the market is not giving our company appropriate valuation right now. Right? I hope you will agree with me. And what I would love to hear your viewpoint as to what is your viewpoint as to how the market value, see, buyback and all are things that one and the board can decide. But what should be the valuation, and how do we improve fundamentally from the business perspective? Gaining market share, gaining volumes, these are, you have done a fantastic job. As always, I said that revenue growth has always been consistent. But there is something that is not working out from the valuation perspective. So would love to understand your perspective as to how do you believe as management you would be able to highlight that to the market and grow it. It may be a combination of several things, right? Like it's just not the growth, but it's growth, margin, cash flow from operations, buybacks, and that can potentially explain that we are in the right direction. That's where, if you can share your views, that'll be fabulous.
So, Mr. Hemal, as a management, we would not like to comment on the market valuations. What we can comment on is the company's performance, in which I am sure you and everybody on this call will appreciate that we have been continuously outperforming. We have grown our volumes much ahead of the market, and 2 to 3x minimum of the market growth rate, we have been able to deliver our volume growth. we have been continuously gaining market share. We have also been able to, deliver good EBITDA growth, good PAT growth. We have continuously been generating good cash flows. Our ROEs are at a quite decent, as a number, quite decent in terms of our industry. We have also been investing in the new age EV wherever we are finding opportunity, and we are looking at more in terms of what we can play the role in EV value chain. We have been giving consistently 40% plus dividend payouts. We have announced last year a buyback as well. So from the perspective, the company is on the right track in terms of performance and gaining market share and continue to outperform. Beyond that, we will not like to comment on the valuation.
So Hemal, just to add to that, as a strategy, as Manish has rightly said, we have also built our brand investments over so many years, and we are today, we believe we are on the top 3 brands. Also, some of our internal data shows we are amongst the top 2 as brand recall and brand consideration. So one of the things is to increase our distribution which we are focusing on in the B2C market. And we are continuously, obviously innovating on products with the long drain and other things. So our strategy is to grow. And as I've been highlighting in the call earlier, lubricant industry is set to grow. In spite of all the challenges we see with EV, it is set to grow 2 to 3% over the next decade and more, which is very clear. And you will see that from the capacities being built up. And of course, the interest in the Indian market. So that is continuing to be a sunrise industry, I would say, to grow. And definitely, that is something which we would also like to keep communicating, that the growth is in the core lubricants. And of course, we are doing things in the EV which will leverage our brand, our distribution. And of course, this is our strategy which we can communicate and assure you that we are working very hard on these. Yeah.
Thank you, sir. Thank you.
Thank you. Thank you so much.
Thank you. We have the next question on the line of Sabri Hazarika from MK Global. Please go ahead.
Yeah, good afternoon, sir. So I just have a conceptual question. So regarding your long drain interval oils that you keep launching, so the net value of these oils, they are like overall accretive for the company, right? I mean, in terms of margin, basically meeting up with whatever the volume decline could be because of long drain. Is that the right way to assess this?
So we have been pioneering long drain oil since more than 15 years, both in commercial vehicles. We give double drain interval. So I think that helps us to get customers to see more value in Gulf, and definitely we get a good price for that. And we have moved our price positioning also up due to these impact of some of these products. And I think that is that in certain segments, long drain is an important delivery, like especially diesel engine oils. And even in our motorcycle, we've had products which signal quality based on the drain interval. So I think these are some of the segments we have chosen where we position the product as a market leader product. And we've also seen that other products have come up from other players in terms of drain interval. So we are a pioneer here, and I think that's been one of our hallmark strategies.
So logically, net, it is like revenue neutral or probably revenue accretive, right? It is not like...
Definitely. You are adding more value and you are able to also get more value out of it.
More returns out of it. Okay.
Thank you.
And sir, second question is relating... has there been any update on manufacturing batteries in India, or you are just like fine with this local sourcing model right now?
No, so we are very close to, finalizing the local manufacturing. I think we are in the process. So as soon as we are through to it, we will be able to announce to you.
Yeah.
And this is also targeted at, say, 14-15% sort of EBITDA margin only, right, for the company?
Yeah, that's what, we believe we can do once we do the local manufacturing and streamline that.
Okay. Okay, sir, fair enough. Thank you so much and all the best. Yeah.
Thank you.
Thank you.
Yeah. Thank you. Participants are requested to kindly restrict your questions to 2 per participant. Participants are requested to kindly restrict your questions to 2 per participant. We have the next question from the line of Chirag from Ratnatraya Capital. Please go ahead.
Hi, good evening. Thank you so much for the opportunity, sir. Just 2 questions. One, could you just help us understand the interest cost component? I believe there's an FX mark-to-market on that. Just help us understand the movement of that a little bit more, and also if there's any ability for you to sort of guide us on what that would look like in the future. And for the 9 months, if possible, could you share an advertising spend number, either as a broad percentage of sales or a number? It would be very helpful. Thank you so much for the opportunity.
Yeah. So thank you. I think, as I mentioned in the opening remarks, out of the 10 crore of finance cost, nearly 4.5 crore is towards forex impact for the quarter. As you see, as I mentioned, we have been importing our base oils and some of the additives and other input costs, on which we follow a hedging strategy, which is to the tune of 50 to 75% depending on the market. And on the open portion, whatever is the impact of rupee movement during the quarter is accounted accordingly. So that's on the forex side. And what was the second question? Can you repeat the second question, please?
That was on advertising, but I'll just come back to the first question. Just the first question a little bit. So essentially, for 25 to 50% of our purchasing exposure, whatever that movement was for the quarter in rupee, I believe 1% or close to that, that translates into 4 crores for us. Is that what you're saying? Is that broadly how I should understand this?
So it is also depending on the the way we fund our working capital. We do take buyer's credit for our imports, and this forex loss is mainly on account of the buyer's credit exposure, to the tune of around 35 to 40 million exposure which we have. So it's not per se, I mean, indirectly it's a raw material, but it is converted to buyer's credit, and then the forex impact comes on that. The second question was on the A&P side. I think we are close to 3% now in terms of our overall revenue, in terms of ad spends. Of course, it has come down, but this is on the higher revenue because of the price increases as well. So there's a combined effect of both higher revenue because of this, and to some extent we have moderated our A&P spends over the last 2-3 years because of the COVID and market situations. Overall, earlier we have been spending close to 5%.
Thank you so much, sir.
Thank you.
Thank you. We have the next question from the line of Sohail Kamdar, an individual investor. Please go ahead.
Opportunity. I would like to congratulate management for achieving a bit of 90 crore. I have two questions. First is I would like to understand what is the current capacity utilization, and is there any capex plan that you would like to share with us? And second question is, like you said, your lubricant growth is 2 to 3% in medium to long term. I would like to understand what kind of sales growth we can assume in long term, because we are now talking about market share gain. So what kind of a growth we should expect? Thank you.
So our capacity utilization, putting both plants put together, is around, we are at roughly 90%. But when we say this, we usually mean on 2-shift basis. We can always increase the number of shifts and increase the capacity in terms of our actual production. Capex guidance we have given in the past, and we continue to remain in the same trajectory, that annually our capex spend is in the range of around 20 crore to 20 to 25 crore, because we need to keep augmenting the new filling lines, keep adding some tankages, keep investing in IT, some of the IT and digitization initiatives. So overall, our capex is usually in the range of 20-25 crore every year. So that's on the capex side.
Yeah. So Mr. Kamdar, on the demand and growth side, the lubricant industry, both automotive and industrial, we are our estimates, and they've actually been also estimates from the experts like Klein. Indian industry, which is the third largest industry, is growing 2 to 3%. Sometimes it will go slightly more, percentage more. And as a strategy, we've been trying to go 2 to 3x times. That means if the industry is going 2 to 3%, we would like to at least grow 6 to 9%. And that is what we have been striving for. And as we explained, we see the same outlook going forward, and we would like to grow. Our CAGR growth in volume, just to give you an estimate, not an estimate, actual fact, that we have more than 10% CAGR growth for the last many, many years, more than a decade. And this year also we have grown. As you can see, we have explained that Q3 was a 10% plus growth, and definitely we are looking at growing in all segments. that we are focused on, both B2B and B2C. We see enough scope for market share. And year to date, this year, just to give you one more fact, we have been growing at more than 18%, exact figure maybe slightly higher. But so we are growing ahead, gaining market share in the segments. Some segments definitely we see rural demand and all, which was slightly subdued, but we are still gaining market share even in those. So that's the background. Outlook would be to grow, continue growing 2 to 3x times the growth. Next year should be about 3-4% growth. So we should look at double-digit growth again.
Thank you very much.
Thank you, Mr. Kamo.
Thank you. We have the next question from the line of Swechha Jain from ANFL. Please go ahead.
Hi, sir. I just have a follow-up question. Just wanted to understand what kind of quarterly run rate in terms of revenue can we expect for next 6 to 8 quarters, and what kind of margins, would you like or would you suggest or give guidance to for next 6 to 8 quarters? I mean, are margins likely to move up to 13, 14, 15% kind of a band, or they would remain in 11 to 12% kind of a band for 6 to 8 quarters? Just how do you think about it?
I think, Sneha, we just answered this question. Swechha, we have just answered both questions in the previous questions in terms of, what is our expectation. We have, as Ravi just now mentioned, we give a volume guidance that we will be growing 2 to 3x the market growth rate, which translate to roughly double digit in the coming quarter and year. And in terms of EBITDA percentage and margins also, we have mentioned that depending on the market scenario, the competition, the input cost, crude movement, there are many variables in terms of gross margin and EBITDA margin. But as a trajectory, we always look forward to going up to our previous band of 14-16%. Before that, we have to move to the next trajectory of 12 to 14, and then we will look for further improvements.
Okay, thank you.
Thank you.
Thank you. We have the next question on the line of Babita Chetwani, an individual investor. Please go ahead. Ms. Babita, can you hear us? The operator, can you hear us?
Hello, can you hear me now?
Yes, we can hear you now.
Yeah, thank you. Thank you for giving the opportunity, sir, and congratulations for the great results that you have shown out as we have every time. So I just have one question. So we have heard a lot about the revenue, but on the cost of materials or the COGS, as we say, what are the 3 major components, and is the company also impacted by the rising inflation in those? And what would be the percentage in terms of the cost proportion, and how are we coping up with the rising inflations in those as well? Like we know base oil has been on a declining trend in this quarter, but how have the other components performed?
So we have again answered this question earlier that base oil, while it has been stable to downward trajectory following crude, other input costs like additives, etc., are still at a very high level, elevated level, and rupee also is remains in a band of 81 to 83, which is a higher band of nearly 10-11% depreciation during the last 9 months or a year. So all these have impacted the input cost. Inflation linked costs are more, I would say, from freight perspective, which are not very significant proportion of overall cost, but these also do impact overall numbers. But overall, I think the major impact is always from base oil, additives, etc., packaging.
Okay. So base oil, I understand, right? But on the additives part, is the company taking any specific measures? Because there are no clear guidelines on how and when the additives are supposed to move, right? So are there any clear measures around it?
So there are specific formulations which are based on specific additives, and these are developed over a very, very long period of trial and based on the recipes. So it's not very easy to keep changing on the additive side. So there is a sort of stickiness to additives, and there are few major global suppliers. But as a trend, they also follow their cost trends, and they look at various chemical indices and all. But of course, there has been a very significant increase in additive over the past 1 year. But we believe that we may see some sort of stability there as well now.
Okay. Thank you, sir.
Thank you.
Thank you. We have the next question on the line of Rahul Chandra from Sunidhi Securities. Please go ahead.
Hello. Yeah, this is Rahul, and congratulations for the good set of numbers. So I have two questions majorly. Can you give the revenue percentage of AdBlue? Because see, I'll try to link the question, which is like your raw material cost per liter on the basis of your volume has significantly decreased on quarter-on-quarter basis, around 8%. So I feel that your increasing percentage in revenue of AdBlue is impacting your realization per liter. So can you guide me like what percentage of the revenue would be AdBlue? And relating to AdBlue, do you need any additional capex or any capex in terms of plants, or can you guide me for that particular thing?
So we have mentioned that the AdBlue volumes have been 21,000 KL during the quarter. We usually do not give the revenue guidance on the AdBlue separately.
No, I don't want the revenue guidance, but I want the revenue breakup of AdBlue as a percentage.
No, so that is not, because AdBlue again is supplied through various channels. It will be very difficult to give you a number on the revenue. But overall, it's a low, realization product, as you have rightly picked up, and accordingly the cost also is very low compared to the normal lubricants. So because of the effect of the combined effect, you see the realization as well as the cost of goods sold both seeing a drop on per liter basis. So while the percentages are different, but I can give you one data.
Ladies and gentlemen, the line for the management has dropped. Please stay connected as we reconnect them back again. Ladies and gentlemen, we have the management reconnected, so over to you.
Yes. Hello.
Yeah, we can hear you.
Yeah. So basically, I was saying that from the gross margin perspective, also this is a lower gross margin product as compared to lubricants.
Yeah, you were going to tell me
CapEx,
something.
we need to have some capex on this, but again, that will be within the overall capex guidance of 20-25 crore. The capex requirement of AdBlue will also be met.
So you increase your AdBlue volume a base effect of 40% on quarter-on-quarter basis. So the capex of 25 crore will suffice that volume growth, if I'm not wrong.
Yes. Okay. So we don't need any significant major capex coming because of AdBlue.
Okay. And my last question is, can you share the percentage of additive in your raw material cost, if possible?
Oh, it's very difficult because again there are different type of additives, and going into diesel engine oil will have a different additive composition versus a motorcycle oil or a high-end passenger car oil. So it's very difficult to give you a percentage.
Okay.
Thank you.
Thank you. That was the last question. I would now like to hand it over to the management for closing comments.
Yeah, thank you. I think we've been tried our best to answer most of your questions and share with you what we've been in terms of the details. But what I would like to leave you with is that definitely we are seeing good momentum in the business. Our business model is surely giving us market share gains. We are focused on automotive and also looking at improving our market share in industrial, in passenger car, motor oils, and hoping that rural demand will pick up with the budget and the things we have seen overall on the macro environment. Margin management remains a key focus area, and definitely we believe our retail sales will grow well, help us to deliver even better performance, while we also look at EV, increasing our industrial market share, getting into EV initiatives, and we are very confident that we'll be again able to deliver 2 to 3 times the industry growth rate. And thank you everyone for your support. Look forward to catching up with you soon. Thank you.
Thank you. On behalf of Yes Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.